Picture this for a second. It's 1962. An African-American family in the South just bought their house. Cash. No bank. No 30-year mortgage. Not owing a single dollar to anyone. Today that sounds almost impossible. But for a lot of African-American families back then, that wasn't the exception. That was just how things were done. And here's what almost nobody explains properly. They didn't pull this off because they had more money. They pulled it off despite having a lot less. That probably makes you curious how they actually did it, right? Because everything points to the fact that they were doing something that, over the years, we simply stopped doing. Something a lot of people today would assume just wouldn't work anymore. But what if that exact same method still worked today? Subscribe to the channel right now and hit the bell, because this is only the beginning of everything you're about to discover today. What's coming up in the next few minutes is going to change the way you see money completely. Alright, let's start from the beginning. To understand this code, we first have to understand something uncomfortable. For most of the 20th century, a lot of African-American families simply weren't given the same access to credit as everyone else. Banks turning down loans for no clear reason, entire neighborhoods marked on official maps as high risk just because of who lived there, something we now know as redlining, mortgages that never came through, no matter how much you earned, how much you saved, or how good your credit history was. Think about what that actually means. It wasn't a lack of effort. It wasn't a lack of responsibility. It was a door slammed shut, no matter how hard you knocked. And it went further than banks simply saying no. In a lot of cities, a family that did manage to buy a home often had to do it through something called a contract sale, paying every month for years, sometimes decades, without ever holding the deed, without building any real equity, and risking losing the entire house and everything they'd already paid into it over a single missed payment. It wasn't really a mortgage. It was home ownership in name only. And that's one more reason why, when a family finally did own a home outright, free and clear, it meant something far deeper than just four walls and a roof. At first glance, this just sounds like an injustice, and it was, without a doubt. But here's something you may have never thought about. When an entire community gets locked out of easy credit, that community doesn't disappear. It reinvents itself. And that's exactly what happened. While other groups could finance just about anything by signing a piece of paper at the bank down the street, African-American families had to build their own system from scratch, with whatever they had. One built on something a lot harder to manufacture than a plastic card: trust, community, and patience. A lot of appliance stores offered something called layaway. You'd put an item on hold, pay it off little by little, week after week, and only once it was fully paid off would you actually take it home. No interest, no debt, just patience turned into a method. Today the system runs the exact opposite way. You take the product home the same day and spend months, sometimes years, paying off something you don't even use anymore. And that exclusion wasn't some small detail. When entire generations are denied a mortgage, they're also denied something much bigger: the chance to leave a paid-off house to their kids, who could then pass it down to theirs. That's what economists call generational wealth today. And it's exactly what that closed door was designed to hold back for decades. That's why, when African-American-owned banks and credit unions finally came about, they weren't just businesses. They were a way of saying, if the system won't let us in, we'll build our own. And here's the first question I want stuck in your head for the rest of this video. If easy credit is supposed to be a benefit to the person using it, why did the families with the least access to it end up in so many cases more financially stable than the ones who had it right at their fingertips? I'm not going to answer that yet. Hold on to it. We'll come back to it later, and when we do, you'll understand why it's the most important question in this whole video. Because what I can tell you right now is this: out of that exclusion, out of that closed door, came something we now lovingly call the Forgotten Money Code. The first piece of that code seems obvious, so obvious that almost nobody pays it any attention today. Save before you spend. Sounds simple, right? But look at what most of us do today. We buy first, then we figure out how to pay for it. That's the exact opposite of how a lot of these families thought. In many African American households in the 1960s, there was a rule that got repeated, almost like a commandment at the kitchen table. If you can't pay for it today, it's not your time to buy it yet. And no, that didn't mean they never bought a house or never took out a loan when it was truly necessary, for school, for a medical emergency. It meant unnecessary debt. The new couch, the bigger car just to show off, the fancy TV nobody actually needed, simply had no place in the family plan. There was a common practice almost in every household, the monthly envelope system. Whole families would split their money into physical envelopes, one for each need: food, rent, church, and one, the most sacred of them all, for savings. And that savings envelope wasn't whatever was left over at the end of the month. It was the first thing set aside before spending on anything else. Think about it. Today, most people save whatever's left over after they spend, if anything's left at all. They spent whatever was left over after they saved. It's just a different order. But that order, repeated week after week, year after year, completely changed the financial destiny of an entire family. That same mindset showed up everywhere, not just inside the envelope. Worn-out clothes got mended instead of replaced. Grandmothers who could turn a handful of basic ingredients into a full Sunday dinner for the whole family. A garden in the backyard that quietly cut the grocery bill without anyone ever calling it homesteading. It was just Tuesday. None of it looked impressive from the outside, but every single one of those habits was doing the exact same job as the envelope, keeping money circulating inside the house instead of sending it out the door. This way of handling money wasn't taught in classes or in books. It was taught by example. Kids would watch their parents count the envelope money at the dinner table on Sunday nights, deciding together what they could afford that month and what would have to wait. And without anyone ever calling it financial education, that's exactly what was happening. A lot of kids had their own little coin jar, their own small version of their parents' system. They'd set aside part of whatever they earned running errands, and they learned early on something a lot of adults still haven't figured out today. The money you don't spend today is the money that gives you options tomorrow. Here's a direct question for you. Don't say it out loud, just answer it in your head. What order are you in right now? Do you spend first and see what's left? Or do you set money aside first and live off whatever's left over? Don't feel bad if it's the first one. Almost all of us are there. That's exactly why this video matters. If this idea is making you think, hit that like button right now. I can tell this one's landing. Let's keep going, because saving was only the first piece. There's a much more powerful one still to come. This is where the story gets really interesting. Because one person on their own can only save so much, but a community pulling together can build things that would take a single family a lifetime to achieve on their own. In a lot of African American neighborhoods, there were what we'd call today community saving circles. A group of neighbors or family members would each put in a fixed amount every week or every month, and on a rotating basis, each person in the group would receive the full pot. This comes from a much older tradition, passed down from generation to generation, known in some communities as a susu: no banks, no interest, no paperwork, just each person's word. and the trust of the whole group. With that money, someone would open a small business. Someone else would fix a roof before the next storm made it worse. A medical emergency would get paid off without ever having to ask a bank that, either way, probably would have said no. And it wasn't just emergencies. The same kind of pooled saving covered the big milestones too. A wedding, a proper funeral, sending a son or daughter off to college. Families and neighbors would quietly put money into the same rotating pot for months, so that when the day came, nobody had to take out a loan to celebrate a life, honor one, or start one. There were also what were called mutual aid societies, organized groups, often tied to a church, where members paid a small regular fee in exchange for knowing that, if something went wrong, the community would step in. A proper funeral, help if someone got sick and couldn't work. All of this, long before affordable insurance was ever available to these families. Churches played a huge role, and not just as a place of worship. They functioned almost like an informal financial network. Community emergency funds, job leads passed by word of mouth, small loans between church members, with no predatory interest, just the commitment to pay it back whenever you could. And then there were the family-owned businesses, barbershops, restaurants, funeral homes, pharmacies, corner stores, all owned by the community, kept alive by the community. Every dollar spent at a neighbor's business was a dollar that stayed circulating inside the neighborhood, instead of leaving for good to some distant company that didn't even know that neighborhood existed. There's actually a name for this: the velocity of a dollar within a community. The more times the same dollar circulates before it leaves the neighborhood, the more collective wealth stays behind, building something. There was also an economy of skills running underneath all of this, one that almost never shows up in the history books. An older man down the street who knew carpentry would take on a couple of teenagers as informal helpers, not for a paycheck, but so that skill would still exist in the neighborhood 10 years later. A woman who could sew would teach 3 or 4 girls on her porch on Saturday afternoons, and suddenly a whole block had less reason to spend money on things they could now make or fix themselves. Picture it in practice. A group of 10 neighbors each puts in $20 a month into the same susu. 9 months in, one member finally has enough to open a small barbershop on the corner. That barbershop hires 2 people from the same block. Those 2 people become part of next year's circle, contributing their own $20, helping fund the next dream on the list. Nobody got rich overnight, but look at what happened. One small pot of trust turned into a business, 2 jobs, and 2 new contributors to the system, all without a single bank ever getting involved. That's the part that's easy to miss if you only think about this as saving money. It wasn't really about the money. The money was just the mechanism. What it actually built was a web of obligation and trust, so strong that people could rely on each other more than they could rely on any institution. And that's worth sitting with for a second, because trust like that doesn't build itself overnight, and it definitely doesn't build itself through a screen. It came from decades of showing up for each other, from knowing that if you put your money in this month, it would still be there next year when it was your turn. Try to imagine building something like that today, in a world where a lot of us don't even know our next-door neighbor's name. Families who'd share a house temporarily while someone got back on their feet, without it ever being seen as a failure, just a strategy. Neighbors who'd watch each other's kids for free, knowing the favor would be returned exactly the same way the following week. People trading work for work. I'll fix your car, you fix my fence, and neither one of us spends a dollar. Today, all of this might sound almost old-fashioned, like something from another era that could never happen again. But stop and think about it for a second. How many people do you know today who'd trust their neighbors enough to do something like that? When's the last time you lent something to a neighbor without a second thought? or a neighbor lent something to you. Tell me in the comments where you're watching this from. I'd love to know who else is discovering this with me right now. You've now got the first two pieces of the code: save before you spend, and multiply your money through community. But there's still a central piece missing, the one that ties everything else together, the one that gives all the rest its meaning. And I promise you, once you hear it, it's going to sound almost too simple to be real. There's one more piece of this code that almost never gets talked about, and it ties everything we've covered so far together: the fully paid-off house. For a lot of African American families back then, finishing off that mortgage, even if it took 10, 15, 20 years of sacrifice, wasn't just a financial goal, it was the biggest achievement of a lifetime. And it wasn't just symbolic. A house with no mortgage meant that, no matter what happened, nobody could take it away over a missed payment. It meant that house became the first real brick in something meant to outlast a single generation. A lot of families planned for exactly that, leaving their kids not just a house, but a debt-free house. And that child, inheriting it without owing a cent, would start adult life several steps ahead of where their parent had started. Repeated over generations, that's what actually builds lasting wealth in a family. Not one good month, not one good year, decades of the same discipline, passed forward. Compare that to what happens in a lot of households today. We refinance the house to pay off other debt. We take out a second mortgage to redo the kitchen. We treat home equity like it's one giant credit card. And without realizing it, we turn what should be the safest asset of a lifetime into a debt that never really gets paid off. I'm not saying this to call anyone out. I'm saying it because that might have been the quietest, most powerful piece of this whole code, thinking not just about yourself, but about whoever comes after you. Let's pause for a second and put all the pieces on the table, because it's worth seeing them side by side. First, save before you spend, not after. Second, multiply what you have through community instead of trying to do it all alone. Third, build towards something permanent, like a home you fully own, instead of something that just looks good this month. 3 pieces, and every single one of them was possible without a high income, without a college degree, without any special access at all. Which brings us to the piece that ties the other 3 together. Before we get to that final piece, let's think about something together. While society back then was shutting the door on easy credit, a lot of African American families were asking themselves a completely different question than everyone else around them. They weren't asking, how do I get this right now even if I can't pay for it yet? They were asking, how do I get this without owing anybody anything? And that difference, that one question, repeated for years, completely changed every decision a family made. It changed what they bought, when they bought it, and above all, how they raised their kids to think about money for the rest of their lives. All right, here we go. I told you at the beginning that once you heard this code, it was going to sound way too simple. And it's true. The whole code comes down to one idea. Don't spend tomorrow the money you haven't earned yet today. That's it. But look at everything that changes once you apply that idea to every financial decision in your life. You stop asking how much you can borrow and start asking how much you can hold on to. You stop spending to look like you're doing well and start spending to actually build something that's doing well. You stop working to pay off your past self's decisions and start using your money to create opportunities for your future self. Picture a family saving for months, week after week, tucking away whatever they could into that sacred envelope just to buy a new stove. The day they finally had the full amount, they'd go to the store, pay for it in cash, and walk out without owing a single cent to anybody. And the kids would go with them that day, They'd watch their mother or father count out the bills slowly on the counter, one by one, no rush, no signatures, nobody pulling up a credit check. That image, walking out of a store with something new and owing nothing, stuck with them for life, far more than any money talk they ever got afterward. That's how a code gets passed down, not through words, but through what kids watch their parents do, over and over. That feeling, that peace of not owing anybody anything, was considered one of the greatest luxuries a family could have, many times more valuable than the item itself. Today we've flipped that logic completely. We buy first, feel the rush for a second, and then spend months, sometimes years, paying off that one single second of pleasure. This code wasn't some financial secret hidden in a book. It wasn't a special bank account or a hidden investment only a few people knew about. It was discipline, a mindset passed down at the kitchen table, not in a classroom, and not in some expensive course. And that's exactly why it survived for so many decades, because it never depended on having money. It depended only on having a mindset, and any family, no matter what they earned, could have that mindset. Let's make a deal. I want to know what you think. Drop your thoughts in the comments because I always read what you write, and a lot of the time your ideas end up turning into new videos. Now let's go back to that question I left hanging a while ago. If easy credit is supposed to be a benefit, why did the families with the least access to it so often end up more financially stable than the ones who had it right at their fingertips? Here's the answer, and I want you to sit with this for a second. Easy credit was never designed mainly to benefit the person using it. It was designed, above all, to generate income for whoever's offering it. That doesn't mean all credit is bad. There are moments in life where a well-thought-out loan opens a door that would otherwise never open. Going to school, buying a house, starting a business. It means that when access is too easy, when all it takes is one click to buy now, pay later, we stop asking ourselves the most important question before buying anything. Can I actually afford this? Or can I only afford this month's payment? The families we're talking about today didn't have the option to buy without thinking it through, and precisely because they didn't, they developed a financial instinct that most of us, generations later, have completely lost. Think about how the message has changed over time. Buying something on credit you didn't need used to come with quiet embarrassment. Today, it's almost a flex. Look what I just bought, never mentioning how many months you'll be paying it off. Stores don't even ask anymore if you want to pay in installments. They just offer it like it's a favor, like it's free, when in reality it's the most expensive way to buy almost anything. There are entire apps now built for one purpose, making debt feel light, almost invisible. Buy now, pay later, split into 4 easy payments, they say. And maybe there's no interest on that specific payment, but what there is a habit that quietly settles in. The habit of never asking yourself if you can actually afford the whole thing, only if you can afford this month's little piece of it. Add to that the subscriptions that renew themselves automatically every month, one after another, small amounts that seem like nothing on their own, but together eat up a huge chunk of any paycheck without us even noticing. And it doesn't stop at apps. Payday loan storefronts and check cashing spots tend to cluster in exactly the same neighborhoods that banks spent decades avoiding, offering quick cash at a cost that makes the old contract sales look almost gentle by comparison. It's the same old door, just repainted. Instead of being told no, you're told yes a little too easily, and the price of that yes gets buried in fine print nobody reads. It's not just apps chasing you at the checkout counter either. Walk through any mall today and notice how many credit card offers get pitched to 18-year-olds who haven't even had a job yet. Free t-shirt, free water bottle, sign here. Compare that to a family in 1962 who couldn't get approved for a mortgage no matter how solid their income was. The doors that used to be locked tight for responsible borrowers are now wide open for anyone, responsible or not, as long as they're willing to sign. Even something as small as a coffee run has been rebuilt around the same idea. Some apps now let you split a fast food order into 4 payments. Think about that for a second. Going into debt over a meal that'll be gone in 20 minutes. That's not a loan helping you build something. That's a habit training you to stop noticing the difference between money you have and money you don't. And here's the part that rarely gets explained clearly. When you only pay the minimum on a balance, month after month, you're not really paying it down. You're mostly just paying to keep the debt alive a little longer. By the time it's actually gone, a lot of people have paid for that same purchase 2, sometimes 3 times over, just in extra cost for the privilege of waiting. The families we've been talking about today never had access to that kind of arrangement. And looking at it honestly, that wasn't only a disadvantage. Marketing has gotten very good at making all of this feel normal, even smart. Build your credit, they say, as if debt were the only path to financial credibility. And there's some truth buried in there. Credit history matters. But notice how rarely anyone finishes that sentence with, "So pay it off in full every single month and never carry a balance," which is the boring, unglamorous part that actually protects you. The families of the 1960s built their reputation the slow way, by paying cash, by keeping their word, by being known in the neighborhood as people who paid what they owed. No score, no app, just a reputation nobody could take away from them. Before you go any further, take a second and subscribe. Every new person who joins helps this community keep growing, and it's genuinely what keeps me motivated to keep making the best content I can for you. Think about your own life right now. No judgment, just an honest look. How many things do you own that you paid for in cash, and how many are still costing you money every month, long after you stopped enjoying them? I'm not telling you this to make you feel bad. I'm telling you because that question, exactly that one, was the starting point of the entire code we've been talking about today. And here's something else worth thinking about. Unnecessary debt doesn't just cost you money, it costs you options. It takes away your ability to say no to a job you don't even like, because you need that income to cover payments on things you don't even remember why you bought. It takes away your ability to make calm decisions, because there's always a payment deadline breathing down your neck. The families we've been talking about today understood something that sounds almost radical today. Real wealth isn't what you appear to have. It's what you can do without anybody being able to take it away from you. And here's the encouraging part. None of this requires a time machine. An envelope system works exactly the same in a banking app as it did in a kitchen drawer. You just have to actually use it that way. A savings circle works exactly the same between 5 coworkers today as it did between 5 neighbors in 1962. The tools changed. The discipline behind them didn't have to. If you ever want to actually try this out, it doesn't take much. Pick one envelope, literal or digital, and fund it before anything else touches your account. Find 4 or 5 people you trust, and start your own version of a susu. Even $50 a month between friends is enough to begin. None of that requires permission from anybody. It never did. That was always kind of the point. The families in this video didn't have a blueprint either. They built one, piece by piece, out of necessity, and it ended up outlasting the very system that tried to shut them out in the first place. That's usually how the most durable ideas get built, not in comfort, but in exactly the kind of pressure that forces you to figure something out. So the real question isn't whether you have access to credit today. Almost everybody does. The real question is whether you're going to use that access the way it was designed to work against you, or the way those families used exclusion to their advantage, on purpose, with a plan, and with the next generation in mind. I want to close with something I think matters more than any fact or figure I could give you today. This code was never some magic formula to get rich overnight. It never was, and anyone who promises you that is lying to you. It was much slower than that, and much more uncomfortable than that. But it gave you something no credit card ever can: peace. The peace of knowing that what you have is truly yours, that nobody can take it away over a missed payment, that your peace of mind doesn't depend on getting approved for more credit month after month. Come back with me for a second to that family we started this video with, the one that paid cash for their house in 1962, owing nothing to anybody. That family didn't have more money than you, they probably had a lot less. What they had was a code, a mindset passed down from generation to generation that most of us today have stopped listening to. And even though the world has changed a lot since the 1960s, the question we're closing on is just as relevant today as it was back then. Is your money buying you the present or building you the future? You don't need to answer that right now. Honestly, I'd rather you take it with you. Think about it tonight before bed, tomorrow in the car on your way to work, the next time you're about to buy something you actually can't afford yet. If anything you heard today made you look at your own money differently, then this story did its job, not because it handed you a magic formula, but because it left you with a question that isn't going to let go of you that easily. And the best lessons never come with an easy answer. They come with a question that stays with you long after the video ends. Think about this one last time. 30, 40 years from now, someone is going to inherit something from you. It could be a house, it could be a business, it could simply be a way of thinking about money. The question is how much of that you're going to leave debt-free and how much you're going to leave as a burden someone else has to keep paying off. That, in the end, was the real gift those families from the 1960s left us. They didn't leave us a fortune, they left us a way of thinking that, if we pick it back up today, can still change the direction of an entire family. The question now is whether we're going to leave it there, forgotten, or pick it back up again. Because here's the thing about a code like this: it doesn't expire. It doesn't need updating for inflation or interest rates or whatever app comes out next year. Save first. Lean on the people around you instead of a lender who doesn't know your name. Build something with a deed, not just a monthly payment. And ask yourself, every single time you reach for your wallet, whether you're about to spend money you actually have or money you're only hoping to have later, do that consistently enough, for long enough, and it stops being a lesson from the past. It becomes exactly what it was back in 1962, just how things are done. Subscribe right now and join this community, because what's coming next is going to change the way you look at money forever. Thank you for staying with me all the way through, seriously. I'll see you in the next video, where we're going to keep digging up these stories that for some reason, almost nobody talks about.